So we have the stock market down today massively, over 1.5%. And the reason is the Fed minutes. So the Fed minutes got released today and they point to earlier, faster rate hikes and more aggressive tightening. So the minutes signaled 3 rate increases this year and 3 the following year as inflation concerns deepened. So what does this mean? 3 rate increases, usually at a quarter of a percent, mean 0.25% increases. And let's look at the graph of the federal funds effective rate. So it was 2.4% in April 2019. It was 1.55% prior to the pandemic. And then it got dropped to, I guess not 0, but 0.8. Anyway, let's first discuss what does it mean when the interest rate rises. When the interest rate rises, the stocks usually go down and the real estate prices usually go down, because the mortgages depend on the interest rate. So the higher the interest rate, the less likely people are to buy houses. So the increase in housing prices that we've seen. So here's the housing prices increase. As you can see, this is 2008 right here, and this is now. This is steeper than it was in 2008, so I think it's pretty fair to say that we can expect a real estate crash. All right, so once the interest rate goes up 3/4 points, which is planned for next year, for this year, for 2022, it's gonna end up somewhere right here. There's 0.65. So it's not a massive rate increase, but the fact that there is an increase is significant. Anyway, what could this mean for the stock market? I think this means, you know, I mean, if we look at the SPY graph of the 5 years, right? The increase in price in SPY doesn't seem that massive. So we're not like, you know, in stratosphere when it comes to SPY, and when it comes to basically right here in like 2019, the rates were 2.5 and the stock market was still growing. So I don't think the Fed rate increases are necessarily going to kill the stock market. It's just a temporary drop. You know, we have a little bit of a different picture with QQQ. You know, QQQ, on the other hand, which means technology companies are in the stratosphere, you know, so it's much riskier to purchase any kind of technology stock at this point. You know, I would stick with the S&P 500, which is, you know, hasn't experienced that much of an increase, but this could drop and this could experience a mini .com boom, bust. But, you know, to summarize, I think that real estate should drop, you know, because again, everything that went up like a huge amount will experience a drop. And this includes real estate and tech stocks. So I think it's fairly safe to stick with the S&P 500, at least until things clear up, you know, on what's gonna happen. So that's just my opinion. Don't forget to subscribe. I'll see you guys in the next video.